With the Forex platform, today it's extremely simple to put resources into gold online utilizing the very instrument that one utilizes to put resources into cash sets. Practically all stages today offer the pair XAU or USD, and the solitary limitation is that gold must be exchanged with the US dollar, since gold exchanging is evaluated in US dollars. For instance, a few trades do restrict the measure of time one can stay in an exchange, and the exchanging times for the utilization of this pair is indicated by certain constraints forced by the London Gold Exchange, which is where the world's gold gets exchanged. In any case, progressively, it's conceivable to exchange the pair much the same as some other, 24 hours every day. Similarly, as with all exchanges you make on the stage, web-based exchanging with gold doesn't need the physical buy or offer of genuine material. You don't buy gold that you can hold. You do utilize the worldwide over-the-counter trade made by the London Gold Market and the clearing and settlement offices they make accessible. However, you won't know about this. You will clear your exchanges similarly as you generally do. Exchanging gold is an issue of understanding the notion of the gold market. The cost of gold is unpredictable. It goes all over as indicated by how financial specialists feel. For instance, when the emergency began in Ukraine, dealers got scared, fled to gold, and the cost went up 2.3% to $1,351.60 an ounce. What happens at whatever point there is a major calamity, a war, or anything that terrifies speculators, and they remove their assets from stocks and securities and purchase gold, either gold assets or the actual metal. The monetary emergency of 2007 to 2009 made speculators apprehensive, and many purchased actual gold, pushing the value for up to over $2,000 an ounce for some time. At that point, the mists dispersed over the worldwide economy, and financial specialists pulled their cash back out of gold into more gainful ventures. The cost of gold returned down to almost $1,000 an ounce in 2013. Also, this is the issue with putting resources into gold. As the incredible master of American contributing Warren Buffett once said, "Why put resources into gold? You put it in your safe. It stays there and sits idle." If you purchase an ounce of gold today and you hold it 100 years, you can go to it consistently and pet it, and 100 years from now, you'll have 1 ounce of gold and it won't have done anything for you in the middle. You purchase 100 sections of land of homestead land and it will create for you consistently. You could purchase the Dow Jones Industrial Average for 66 toward the beginning of 1900. Toward the century's end, it was 11,400, and you would likewise have been given profits for 100 years. So a nice gainful resource will murder a useless resource. This is, obviously, an outrageous view from a functioning financial specialist. However, the facts confirm that performing ventures are simpler to decide than gold. There is, obviously, some interest for gold for making gems, and, in China and India, customers think about purchasing gold as flat-out need, a fundamental piece of homegrown security. Shoppers in China and India show the best interest in gold on the planet, and when they purchase, they do certainly affect the cost of the metal. Be that as it may, you can perceive how this works out in a report from the World Gold Council. Shopper interest for gold rose 21% in 2013 as the craving for gems, little bars, and coins hit a notable high of 3,863.5 tons. This was generally on the rear of interest from China and India. Gems request was at its most elevated since the beginning of the monetary emergency in 2008, coming in at 2,209.5 tons. This indicated an increment of 17% from the earlier year. The interest was fueled to some degree by the way that the cost of gold was lower in 2013 than in the earlier year. Furthermore, financial specialists, still stressed over security, kept up interest for bars and coins, which flooded to an untouched high of 1,654 tons, estimated at $75.0 billion. With the entirety of that, general interest for gold dropped 15% in 2013. Speculators were, when all is said and done, not really hazard off as the monetary world calls it, thus they set their cash back into stocks and bonds. Gold performed more terrible than practically some other resource, notwithstanding all the interest from purchasers in China and India. Nothing could make it plainer. It's exceptionally hard to tell what gold will do and when. The one time you are probably going to make certain about putting resources into gold is the point at which poop hits the fan, a war, a quake, a monetary emergency. Whatever shakes individuals up makes gold go up. In different occasions, it's most likely insightful to avoid gold. There is a figure. Nomura Securities has raised its 2014 gold value conjecture to $1,335 for each ounce for 2014 from the past $1,138 for every ounce, as the Nomura expert clarifies. The speed of a year ago's value decrease presents the beginning of the following cycle. Gold seems set to recuperate like a phoenix recovering from its remains, the Nomura Examiner figures. A few significant venture banks, including Japan's Nomura, Switzerland's UBS, and London's RBC Capital Markets, have all as of late raised their gold value estimates. UBS presently anticipates that the cost of gold should average $1,300 per ounce this year, while RBC has set a normal of $1,400 for every ounce. For 2015, Nomura predicts a gold cost of $1,460 for every ounce. Gold has just ascended by around 12% this year, part of the way because the U.S. Federal Reserve declared that it would hinder its strategy of quantitative facilitating, or intercession in security markets and simple liquidity. For the informal investor, amidst this vulnerability, a specialized way to deal with gold dollar is maybe the most secure. Momentary changes in the XAU-USD pair are maybe best perceived as far as pullbacks and breakouts. Positively, one should watch out for basics. However, watch opposition and backing floor cautiously also.